Is it better for you to have a growth strategy or defensive strategy? An investment portfolio should contain a mix of growth and defensive assets, and the balance that suits you best requires regular fine-tuning as markets and investment cycles change. And in the finance world, some experts think of an investment portfolio in terms of a core with several satellites. The core, depending on the investor's age, goals, risk appetite, and the conditions within the market, may consist of defensive investments. The satellites may include more growth assets. As the investor ages and the investment period contracts, the satellites are drawn inwards to become defensive and strengthen the core. Most investors understand a defensive asset class to be one that relies on income to deliver a return. Such classes are perceived as being more stable, particularly in a turbulent market. Growth assets, on the other hand, tend to rely on capital growth or price movement and are perceived to offer better growth opportunities in a positive market. A fixed income cash account, for instance, can be defined as defensive, while shares are often seen as growth. But as with many things in finance, it's not quite that simple. Within specific asset classes, whether they are fixed income, shares, property, or anything else, there are growth and defensive choices. A mix within each asset class is just as important as the actual mix of asset classes. A defensive share in a utility or infrastructure business, for instance, will likely follow a different cycle to a growth share in a technology or mining business. Shares in an individual company could be classified as defensive or growth depending on the company's level of debt and its future projects. Higher levels of debt could mean more future growth as the company borrows to spend on new initiatives and projects, but it might also mean a higher level of risk if the new project doesn't perform as well as hoped. So as a general rule of thumb, growth investments require a long-term mindset, and while you might make short-term gains, there could also be short-term pain in a market downturn. So the longer you invest across growth asset classes, the better your chance of riding the peaks and troughs. So what if you only want safe investments? Particularly as people approach retirement, it's natural to become more cautious about investing and prefer a more defensive approach. Many retirees were understandably worried about their super after the GFC in 2008, which led to some knee-jerk reactions to try and avoid as much risk as possible. Of course, no investment is completely risk-free, and while defensive investments may give you more peace of mind, it's usually not prudent to put all of your eggs into one basket by putting all of your investments into, say, a term deposit. You may still miss out on growth that you could otherwise have achieved without radically increasing your risk profile. Just as a winning sports team must have effective attacking players as well as a solid defensive line, a winning portfolio should contain a mix of growth and defensive investments. It's also good to be mindful when talking to younger generations, as their risk profile and time available to invest are different to people closer to retirement. Instead, recommend that they seek their own professional advice. So if you would like to learn more, talk with an Allstar Wealth Advisor today on 1300 788 936. The information in this video is neither professional advice or instruction and is not to be used as such. For specific terms and conditions and rates used in this video, please refer to the PDF download provided. For professional help, please contact John Waters at www.allstarfinance.com.au.